Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Xinhua Winshare Publishing and Media Co. Limited Annual Report. Xinhua Winshare Publishing and Media Co. Limited offers a diverse range of businesses and services in the publishing and distribution industry. The company's primary segments include publication and distribution, which encompass various activities such as book publishing, newspaper production, journal publication, audiovisual product distribution, digital product development, printing services, and supply of printing materials. In addition to these core operations, Xinhua Winshare also engages in the wholesale and retail of prepackaged goods, import and export business, property leasing, catering services, exhibition of artwork, advertising agency services, and leasing businesses. The company also invests in project management and cultural exchange activities, providing computer software development and system services, business consulting, online sales, and event planning services. Furthermore, Xinhua Winshare offers logistics and business services, including the distribution of textbooks to schools, teachers, and students, as well as educational materials for primary and secondary schools. The company also provides retailing, distribution, and online sales of publications, making it a one-stop shop for various publishing needs. Overall, Xinhua Winshare's extensive range of businesses and services makes it a significant player in the Chinese publishing and distribution industry. Xinhua Winshare Publishing and Media Co. Limited, market capitalization of 17 billion, is significantly larger than the average industry peer of roughly 0 billion. This shows that Xinhua Winshare Publishing and Media Co. Limited holds a significant advantage in their industry. Xinhua Winshare Publishing and Media Co. Limited trades at an unknown price-to-earnings ratio of 7 times and a higher price-to-book ratio of 0.74 times relative within the industry. This suggests a potential market detachment, as Xinhua Winshare Publishing and Media Co. Limited trades at discounted levels while the broader industry remains fairly valued, warranting deeper fundamental analysis. The company maintains a moderate leverage profile, with liabilities making up 34% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have increased consistently as the company expands. Importantly, both assets and shareholder equity have grown at least 20% faster than liabilities, indicating that the business is expanding substantially and generating value after covering its obligations. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The company have a dividend yield of 6.48%. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. Additionally, special charges appear non-recurring, suggesting high earnings quality and strong financial resilience. The primary drivers of revenue growth or decline in a given industry can be attributed to several key factors. On the positive side, content e-commerce has seen a significant increase of 30.43% year-on-year, while the publication segment has experienced a growth rate of 22.31%. The distribution segment has also shown an increase in sales volume from 34,218.1 to 37,035.51. Furthermore, enhanced quality of content creation, differentiated product strategy, and strengthened building of specialized brands have all contributed to revenue growth. Additionally, the development of supplementary material products, meeting new curriculum standards, and expansion of subscription channels outside Sichuan province have also played a role. Technological innovation and integration with high-quality resources have further boosted revenue. On the other hand, revenue decline can be attributed to several factors. The wholesale of publications, distribution of primary and secondary school textbooks, and sales of general books and textbooks have all seen declines in revenue. The education informatized and other business segment has experienced a 11.57% decrease, while newspapers and journals have seen a year-over-year decline of 27.68%. The distribution segment has also declined by 6.03%, with general books experiencing a 2.59% year-over-year, revenue decline in textbooks, and supplementary materials, seeing a 10.2% year-over-year revenue decline. The net income of the company experienced a significant decline, with a decrease of RMB 71,999,000, RMB 34,021,070.09, 4.84% year-on-year to RMB 11,732 million, and 27.68% year-on-year. This downward trend in net income is attributed to various factors. One major reason for the decline in net income is the decrease in sales of textbooks and supplementary materials due to unfavorable market conditions. Additionally, changes in preferential income tax policies for restructured cultural enterprises have also had a negative impact on the company's net income. Furthermore, external market conditions and changes in sales structure have contributed to the decline. The profit margins of the company have also been affected by these factors. The operating profit margin decreased from 13.4% to 12.9%, while the net income margin decreased from 14.3% to 13.2%. The gross profit margin, which is a key indicator of profitability, decreased by 1.11 percentage points to 35.6%. This decline in profit margins can be attributed to increased market competition in labor and practical education services and teacher training business. In conclusion, the net income and profit margins of the company have declined significantly due to various factors such as unfavorable market conditions, changes in tax policies, external market conditions, and increased competition. These challenges have had a negative impact on the company's financial performance, highlighting the need for strategic adjustments to mitigate these effects. The company's financial performance is a notable aspect of its overall success. One key indicator of this is the generation of positive operating cash flow. This means that the company is producing more cash from its core operations than it is spending on them. According to the provided data, the company has consistently generated significant amounts of operating cash flow in recent years. In 2024, the amount was RMB 3,511,819,116.51, and this increased to RMB 2,351,111,419.19 in 2025. This increase may be due to various factors such as improved operational efficiency or enhanced revenue streams. The positive operating cash flow is a crucial aspect of the company's financial health, as it allows for investments in growth initiatives, debt repayment, and other strategic uses that can drive long-term success. The company's financial performance has shown some fluctuations in its debt level and interest expenses over the past year. In terms of interest expenses, there appears to be a discrepancy between two different pages of the summary. On one hand, it is stated that interest expenses increased by RMB 1,323,520.27 from the prior year to the current year, page 4. However, on another page, it is noted that interest expenses decreased significantly from RMB 950,884,516.13 in the prior year to RMB 790,182,397.07 in the current year, page 7. Regarding debt level, there are some changes observed. Short-term borrowings remained unchanged at RMB 10 million, as indicated on both page 2 and page 63 of the summary. On the other hand, notes payable decreased from RMB 4,486,667.5 to 0, page 2. The performance of various segments and regions in the industry has been analyzed, revealing both positive and negative trends. In terms of strong performance, the distribution segment stood out, with a significant growth rate of 7.74% and sales value growth of 7.15%. This indicates that the distribution channel is efficiently meeting customer demands. Another notable performer was the publication segment's plate lease textbooks and supplementary materials, which recorded an impressive growth rate of 22.31%. On the other hand, some segments and regions struggled to keep pace with industry growth. The general books category within the publication segment experienced a decline in growth rate, with a negative 11.19% growth rate. Similarly, the printing of textbooks and supplementary materials also underperformed, with a growth rate of -9.23%. These results suggest that these areas require attention to improve their performance and stay competitive in the market. Management's outlook on company strategy. The management is focused on accelerating the development of the cultural industry, with a goal of establishing the company as a first-class cultural media group in the People's Republic of China. To achieve this, they are implementing growth strategies and improving the existing industrial layout. One key aspect of their strategy is making strategic investments to drive growth, such as in Bank of Chengdu and Wanzin Media. These investments are expected to generate attractive dividend income and higher capital appreciation potential, contributing to a positive outlook for the company. Overall, management's optimism stems from their confidence in these growth strategies and investments, which they believe will propel the company forward in the cultural industry. The company's financial records indicate a history of paying dividends to its shareholders. Specifically, in 2024 and 2025, the company received dividend payments, as reflected in the dividends receivable section on page 1. Furthermore, on December 23, 2025, the company paid an interim dividend of RMB 0.19 per share, with a proposed final dividend for 2025 of RMB 0.42 per share, as stated on page 70. There is no evidence to suggest that the company has engaged in share buybacks during this period. Concerns about inventory buildup and supply chain disruption have been raised due to several indicators. Firstly, the carrying amount of goods on hand and raw materials has decreased significantly, indicating a potential issue with inventory levels. However, this is somewhat offset by an increase in provision for impairment of inventories, suggesting that some of these items may be written off as losses. Furthermore, gross income for various segments has declined, including textbooks, general books, newspapers and journals, and education informatized and others. This decrease in sales revenue could indicate a disruption in the supply chain or a decline in demand. Additionally, one segment experienced a negative sales value growth rate of 12.53%, which is a clear sign of trouble. While inventory turnover days have decreased by 4.8 days, this may not necessarily be a positive trend. It could also suggest that inventory levels are being reduced due to a decrease in sales volume or a disruption in the supply chain. Overall, these indicators point to potential concerns about inventory buildup and supply chain disruption. That concludes the financial summary for Xinhua Winshare Publishing and Media Co. Limited. Feel free to comment below, and I will be happy to answer them when possible.